part 2 of the CPA review on revenue recognition. We'll talk about a few topics that you all know conceptually. I'll just highlight the part that you will see a little new. You may not read it directly from the slides. So first is talking about the incremental cost. If there is an incremental cost that involves in obtaining a contract. Right, so for example, if you want to get a customer or to win any contract, you may need to pay some additional costs. So now the question is whether you will record those costs as regular expense or you will show those costs as an asset. So there is the rule. So you can show any costs that are incurred to fulfill a contract as an asset if those are directly related to the contract and those generate or enhance the resource of your company, and those are expected to be recovered. And you will see one example they provided here, that you want to perform a customer to prepare a software for a customer, and what you had to do, the software, the contract was that it will be for $240,000, but you need to buy another workstation for your technical team, and you spend $8,000, and you also had another employees who is working for that, and that employee you assign one employee, but that employee also works for all other customers, and you pay that employee $30,000 annual salaries. So now $240,000 of course will be the contract price, but the additional $8,000 you paid to buy the workstation, which you had to only because of that contract, whether you will show it as an asset or an expense. Now look at that. These station you had to buy specifically for that contract, so it's directly related to the contract, and then it of course is enhancing your resources, right? It's long-term benefit you will get through it, and of course here you will expect that the cost will be recovered because you'll be using for a long time. So that's why that workstation cost you can call as an asset. On the other hand, the employee that you used for that contract, that employee serving for other contracts too, rather than recording that employee's salaries as a part of the contract or the assets, you can record that as a regular expenses. So usually selling, general and administrative expenses you actually record as an expense. You only record any cost related to the contract if it's directly related to the contract, because otherwise you would not have to spend that money, and it enhances your resources, and you expect that the cost will be recovered maybe in the short run or long run. That's the new thing you will see in the CPA book. And then here that are talking about the principal and agent, it's pretty much the same theory. So principal actually controls the goods and service, or provides the goods and service to the customer, and agent actually works as an intermediary, and you will also see the example there. And then they're talking about the repurchase agreement, and you also learned it, the repurchase agreement, that the seller can repurchase the asset that is being transferred to the customer. Now the question is, what is the repurchase price? If you will see that the repurchase price is less than the selling price, then you will treat it as a lease, right? And it's the same concept you learned from your slides. But if it's more than the selling price, we treat it as a financing arrangement, and the difference we show it as interest expense. So here you will just see a little difference. They use the term call option and put option. Don't be confused. Call option means it's right to buy. That means the seller has the right to buy, repurchase. And put option, on the other hand, it's right to sell. That means that if the entity has an obligation to repurchase the asset at customer's request, that means customer is requesting that customer wants to resell the assets and it's less than the original selling price, then they called it as put option, which is pretty much like the lease. So don't be confused seeing the terms here. Put option, call option, concept, journal entries are same. Then they talk about bill and hold, and they discuss that gap requirements when you are still holding the product, right, and you are not physically transferring the product, or physically the control is not being transferred. You still can record it, because there should be some reasonable there should be some reasons behind that, and that product should be separately identified, and the product should be always be ready to transfer to the customers, and you cannot use that product for any other purpose. And you will see the same example. Then they talk about the consignment example, consignor and consignment example. It's also similar to the principal and agent example, and they gave you the example of a car manufacturer and the car dealers. So the car manufacturer who controls over the cars and providing the original products, so they will record the revenue. On the other hand, consignee cannot record it, because they are just working as an intermediary, just like the agent. They talked about the warranties. There are different type of warranties, and if it comes with the product, it's guaranteed with the product, it's assurance type warranty. But you could have separate warranty in addition to that. So in that case, the separate warranty will be separate performance obligations, and they explained some here the conditions. You will see here that when you will show those type of warranties as separate performance obligations, right, and when you will not. So depending on those conditions, for example, you will look at the law requirements related to the warranty and the warranty coverage period, of course the likelihood, how likely that you have to perform and provide the warranty, right. So you will look at those conditions. Those are the new points you will see. And then here, last topic, they talked about the sales returns. So when there is a possibility, a part of the contract says that the customer can return any goods, and then you have to refund the customers. So how we will record that? So we of course record whatever we receive from the customer as the purchase price or the contract price, transaction price. And then if you know that the likelihood of the sales return, you can estimate that 5% of the products we will get the sales return, either based on the previous experience, or you know that those products may not satisfy the customer, could not fulfill what they are expecting. So if you know that, then you will show that part as a refund liability as opposed to show that as sales revenue. So that's the example you will see. And once you see that the customer actually would not return it, then you will eliminate that refund liabilities. Now you will see one quick example at the end of this module. Let's see. Jojo Roasters manufactures and sells coffee beans, and they entered into a contract with Smooth and Bold Coffee to manufacture 5 roasters for their new facilities. And the roasters were manufactured and based on their specifications, and they completed on time. That was the contract date that they completed on September 1st, year 2. But due to delays in the construction of S&B's new facilities, because they actually will be using those coffee roasters for the new facilities, but they could not finish the construction of the new facilities. So Jojo said that okay, so we can actually keep those coffee roasters in our facility, in our warehouse, although we completed the product. So we are billing them, but we are still holding the product until they complete their construction, right? And then they paid on October 1st, year 2. Now when you will record the revenues, look at the deadlines here. So Jojo actually completed the product on September 1st, year 2, and they're ready to deliver those. But on the other hand, your customer is not ready to receive those products. Rather, they say you have to wait until the next year, January 10, and they already paid it. So what type of example is it? It is bill and hold example. Now you know GAAP tells you some conditions, and you check that okay, the products are completed and ready to deliver, and there is a substantive reason why the customer is not taking the product, and they will not be using the product or not selling it or giving it to some other customers. So they have every right to record it on the day they completed or fulfill all performance obligations, which happened on September 1st, year 2. So your answer will be A. So this type of conceptual question you'll frequently see on revenue recognition.